So what I want to do right now is help with some questions that people have been asking about the statement of cash flows. And for this one, I'm going to be using A5-7 in the textbook. And this one's from Connect. So every time you do it, you'll have different numbers to work with. So this particular one, you can see the income statement with net income of 173.4 here and the balance sheet. In addition to that, there's one piece of an additional information here where it says during the year, equipment with original cost of 101,800 was sold for cash. So what I want to do first is talk about where everything goes in terms of your analysis. So if you're starting the statement of cash flows, you're going to start with the operating activities section. So what do we need for that? Well, we need our net earnings and comprehensive income, which is 173.4. That is the starting point of our statement of cash flows. So you could see that here from in operating activities, we start with net income of 173.4. Next, what we're going to do is we're going to get rid of any of the non-cash items on the income statement. And there's a few here. Depreciation is a common one. This reduced net income, so we have to do the opposite and add it back. The loss on sale of equipment, that's non-cash also. It decreased income, so we have to add that back. But we also had a gain on sale of an investment, so that's going to be added back into income. And you can see all of those items right here that I just talked about. So this is the solution. Net earnings as a start, add depreciation, add back the loss on sale of equipment, and subtract the gain on sale of investment. The next thing we do is we analyze all of our current assets and current liabilities to get the rest of our cash from operations. And that's because accounts receivable, inventory, accounts payable, and income tax payable all have accrual accounting in them. And if you remember our rules, whenever a current asset like AR here went down from 104 to 91, the decrease in AR is always added back to cash. Whereas if it's an increase, like in this case with inventory, it went up, that means we bought more, so cash goes down. So again, for current assets, whatever direction they go in, if they go up, cash goes down. So it's always the opposite direction for current assets. For current liabilities like AP and income tax payable, well, if you look at AP, it went down. Well, that means cash also goes down. Income tax payable went up, so it goes the same direction for current liabilities. Cash would also go up. And you can see that right here. So the next part of the section here, decrease in AR. As I said, when it's a decrease, you do the opposite and increase. Increase in inventory, opposite. For the decrease in AP, well, because it's a decrease, liabilities go the same direction. So decrease, decrease. Increase in income tax payable is an increase. So that's how the statement of cash flow works for the net cash from operations. But really what I'm going to get into in more detail with some calculations are the other sections, investing and financing. So next we're going to look at the investing activities section. And what I do when I'm doing my both investing and financing section is use what's called T accounts. T accounts is simply explaining everything that happened in different accounts. And for investing, we're always looking at our long-term assets. And if you look on the balance sheet here, we have only one. We have equipment with accumulated depreciation, and we also have an investment. So we have two different ones actually in this case. Now for the equipment, we actually have to go ahead and do the T account. So we're going to do equipment, and we're going to do accumulated depreciation on equipment. And that's the first thing we're going to do is fill out everything we know about these two. And the reason is we know we sold some, but we know something else happened. We know it went up, so we must have bought some, but it doesn't tell us. So we have to put everything we know so far. So I'm going to start with the beginning balance, which is right from the balance sheet. And if you look at equipment on the balance sheet from 2021, it was 485,100. So let's go ahead and put that in there. And we're going to should have formatted all of these as like that, and we'll just copy that format to all my other T accounts here too. I usually set up a few. I don't know how many I'm going to need. I might need to do some more after when we're analyzing, but we're starting out here with equipment. So we started with 485, 100, and we end with 567. Okay. Oops, I put that in the wrong spot, but that's okay. We're going to have probably a couple things we have to do here, so we're going to leave it like this for now. And then accumulated depreciation, again, we have to record the beginning balance and the ending balance, and it's on the credit side because it is the contra account for equipment. So we started with 233,700 and we ended with 235,600. So that's the first thing we're doing with our T accounts. Okay, now you can see that there was a change in accumulated depreciation for equipment, and we know that depreciation expense goes in. And if you are kind of going, well, what else do I put in these things? Like, how does this exactly work? Obviously, if you buy equipment, it would be an increase here. If you sell it, the cost that you sold goes here. And we know equipment with a cost of 101,800 at the bottom sold. So we know we can put that right there, 101,800. So those were equipment sales. So we can put that in because the question gave it to us, but we know we're still not balanced there. So to fill out the rest of the T accounts here for equipment, because we already know the cost of equipment sold, we know we're going to need the accumulated depreciation on the equipment sold. So that's one thing we're going to need to calculate. And the other thing we're going to need is the equipment purchase. That's the other thing we don't know. But we have enough information already to figure out this amount purchased, because if you look here, we had this amount, 485,100. We subtract this, we don't get this. So we can just do a simple, let's just put a subtotal in here first. That's the easiest way to do it. So our subtotal is 383,300. So how much did we buy? Well, I'll just take the difference between the two numbers here. We purchased an additional 183,700. So this is going to be an investing outflow. So in the investing activity section, we need to have an outflow of cash of 183,700. Now, when you want to figure out the equipment sold, what we really need to know is how much did it sell for? This is the cash we paid to buy new equipment, but this is the cost of the equipment sold, not the actual cash. So it told us it was sold for cash, but not how much. So we need to figure that out as well. But the first thing to do with that is we need to know the net book value sold, because then we can do the rest of it. So first, let's fill the rest of this accumulated depreciation T account out. So when you're doing depreciation expense, you're going to do a journal entry, debit depreciation expense, credit accumulated depreciation. Well, how much is that? Well, it's on the balance sheet. The depreciation expense is 25,900. So that's the amount I'm going to put in here as my credit part of this particular journal entry. So hopefully everybody understands that accumulated depreciation from the income statement is going to be the amount you need to always add into this accumulated depreciation T account. So if we start with this opening and we add this and we got to our ending, that would have meant nothing sold. But in this case, obviously this does not reconcile. So we need something here to balance it. So we're just going to take the amount here. So we added this, but we're left with this. So how much is it? 24,000. So that is the accumulated depreciation on the equipment sold. So now we're ready to actually start with our journal entry for the equipment sold. I'm putting purple things through on what we have to put on the cash flow statement so that when you do your T account analysis, you can track each item that you need to put there. So on the equipment sale, we need to debit cash for the equipment sold. That's what we're trying to calculate. And that's, I'm going to put that in yellow. Yellow is all the things I need to figure out in this question that aren't given to me. I need to debit my accumulated depreciation on the equipment I sold, because really I need to get rid of everything related to the sale of equipment. So the sale was 24,000, so I'm going to formula that up to the T account. And then of course I have to credit the cost of the equipment sold, which is right here. And then the other thing is, if you, to figure out the cash on, or to figure out the gain and loss on sale, you always take cash minus net book value. The net book value is the 108, the 101,800 minus this. And we know what the loss is. So in this case, it said there was a loss on sale of equipment of 31. So that's actually going to be a debit. And if it was a gain, I would have put it as a credit, but this is a loss. So I'm going to say loss on sale, and it is 3,100. So now all I have to do to figure out the cash is to balance this journal entry. So my journal entry, I have 101,800 here on the cost of equipment sold, minus my accumulated depreciation on that equipment sold, minus that. My cash that I got on the equipment sale is $74,700. So this is going to be an investing inflow. Somebody bought our equipment, we got cash in for that. So basically those are the two items here I have for equipment. I bought some and I sold some. So those both go on the investing activities section. The next thing that you have to look at is investments. In this case, it looks like they sold some, and this is a little simpler because all you have to do is you take the amount sold and then you say, okay, well, there was a gain. Well, if you take the difference between these two and you add the gain, that's going to be the cash on sale. So I want everyone to take a minute and try to calculate that before I put it here. So hopefully some of you were able to calculate the cash from selling the investment, but if not, let's just do that. So we had 80,600 worth of investments last year. This year we have 55,800. So that means we sold investments for 24,800. That's how much we had bought them originally. Well, we know we sold them for more than what we bought them for because we had a gain. So how much was the gain? It was 2,300. So the cash we must have received is 27,100. So that is going to be an investing inflow as well. So let's put that in purple. Everything in purple we're going to go look at after to make sure we've put it all on the cash flow statement. So we have the purchase here of equipment, the sale, and now a cash received from selling an investment. So I guess I could type investment right here. There we go. So now that we're finished investing, we want to get into our financing activities section. So that's the next one. And we're going to look at all of our long-term liabilities and equity when we're doing financing. So for long-term liabilities, what do we have? Well, we have bonds payable here. So it was started at 0 and now it's 46,600. So that's a fairly simple one. You can just put on your chart here. I'm just going to type it on here. I'm going to say we had a bond issued for $46,600, and that is going to be a financing inflow. So that's the first one on the financing side. The next thing we have to look at is common shares. Now in this case there are no common shares changing because the balance stayed exactly the same. Sometimes you'll see there's more. They don't tell it to you, but you have to say, okay, we sold more shares, so that would have been a cash inflow. The other account that I would always analyze using a T account is retained earnings. For retained earnings, there's a couple things that happen. One is obviously that we start with our beginning balance and our ending balance, but we also always have to put in our net income from our income statement, which is the linkage between the balance sheet and income statement when you're doing complete statements. So our beginning balance of retained earnings is that one there, and then the ending 307,100. So as I mentioned already, we have to take our net income from the income statement and put that in here. So that's the 173,400. And now I want to do a subtotal and say, okay, if nothing else happened, I would have been at 418,800, but I'm only at 307,100. That must mean that I had some dividends this year. And all you do to calculate the dividends is just figure out how much it decreased your retained earnings. So this would also be in the financing section, and it's an outflow because we paid cash for dividends. Some of the questions we had would say some were stock dividends. Well, stock dividends aren't paid out in cash, so if that was the case, you would deduct that out of this. But in this case, our financing outflow is the full amount because it doesn't say anything about part of it being in a stock dividend versus a cash dividend. So I don't need this last T account because if you look here, we've calculated T accounts for our long-term assets and our long-term liabilities, or calculated everything we need for there. So finally, what I want to show you here is the actual statement of cash flows here. And you can see the operation activities. We already talked about that earlier on, so that's simple. But now let's look at the ones we just completed the T accounts for. So here is the investing activities. So the proceeds on sale of investment of 27.1 that we said that was going to be an investing inflow here. The proceeds on the sale of equipment, which we calculated right here, debit cash 74,700 as an inflow, and of course the purchase of equipment, which is right here in our T account that we calculated of the 183.7. And then on the financing side, we issued the bond, like we said, for 46.6, so that is a cash inflow. And then, of course, we paid the cash dividends, which was the outflow. Now, you don't always have to do T accounts. You can do it other ways. The solution does not show it using the T accounts the way I do it here, but this is the way that I always find is the easiest. So hopefully this helps you a lot, and just keep practicing, and it'll make cash flow statements a lot easier.